You signed a 30-year mortgage. You think you'll pay it off in 30 years. You won't. The real number is closer to 60, and the bank knew this before you walked in. Look at your last statement. Find the line that says principal. Find the line that says interest. One of those numbers is small, the other is enormous. That gap is the trap. Most people glance at the total payment and feel proud. $1,200 gone, another month closer to owning the house. That feeling is the lie. You barely moved. In year one of a 30-year mortgage at 6%, you pay roughly $14,000. Of that, only about $2,000 touches the principal. The rest is pure interest. $12,000 vanished into the bank's pocket. Your loan balance dropped by 2. You did not buy a home this year. You rented it from your lender at a brutal price. Year 2, almost identical. Year 3, year 4, year 5. For the first decade, the bank takes the bulk and gives you crumbs of equity. This is not an accident. It's called front-loaded interest. The amortization schedule is built so the bank collects its profit first. By the time you start owning meaningful equity, 10 years have already passed. 10 years, a decade of your working life. And if you check the numbers, you still owe over 80% of what you originally borrowed. 80% after 10 years of payments. Now the second trap closes. Most people don't stay in the same house for 30 years. The average homeowner moves or refinances around year 7. Year 7. At year 7, you've paid the bank almost $100,000. Your equity is maybe $15,000. Then you sell, you move, and you sign a brand new 30-year loan. And here is where the 60-year math kicks in. Every time you refinance or move, the clock resets. The bank starts collecting front-loaded interest all over again, from scratch. You are not paying down a house. You are feeding a machine that resets itself the moment you get close to escaping it. Most people will do this 2 or 3 times in a lifetime. Here's the lie you've been told. A mortgage is forced savings. Every payment builds equity. Real estate always goes up. Your home is your biggest investment. None of that is fully true. Forced savings only works if the savings part is bigger than the cost. In year 1, you saved $2,000 and paid $12,000 in interest. That is not saving, that's bleeding. The equity story sounds clean until you compare it to what that interest money could have done somewhere else. $12,000 a year for 10 years invested at 7% becomes $166,000. Most people don't have that money to invest because the mortgage already took it. The bank captured the compounding that should have been yours and put it on their balance sheet instead. And the real estate always goes up story, tell that to anyone who bought in 2007, or anyone whose neighborhood declined, or anyone whose property taxes doubled while wages flatlined. Your home is not always an investment. Sometimes it's a savings account that charges you interest, taxes, insurance, and repairs to use it. The math gets ugly fast. Here's another piece of the lie. The realtor says, why pay rent when you can build equity? But in the first decade, 85% of your payment is not building anything. It's going to interest, taxes, insurance, and maintenance. Only 15 cents of every dollar actually buys you the house. The other 85 cents disappear into the same hole rent does. The buying versus renting comparison usually leaves out closing costs. 6% on a $400,000 home is $24,000, gone the day you sign. It also leaves out the opportunity cost. The down payment you put down, $80,000, could have grown for 30 years. At 7%, that's $600,000. But the lie keeps working because nobody runs the numbers. They feel proud of the keys. They feel grown. They tell themselves they're doing what their parents did, and the trap closes quietly. The lie doesn't survive a calculator, but most people never bring one. They bring emotion, a real estate agent, and a lender who profits no matter what. Here's what's actually happening inside your loan. Every payment is split by a formula called amortization. The formula is rigged, so the interest portion shrinks slowly while the principal portion grows slowly. In month 1, the interest line is huge and the principal line is tiny. The formula recalculates each month based on the remaining balance. So as you pay it down, interest naturally drops, but the drop is microscopic in the early years. You don't hit a 50. 50 split between interest and principal until somewhere around year 18 of a 30-year loan, 18 years. Until that point, the bank is taking more of your payment than you are. You are technically the borrower, but functionally the bank owns more of every check than you do. The system doing this to you is not personal. It's just the structure of the loan. The longer the term, the worse it gets. A 30-year mortgage is mathematically designed to maximize bank profit. Compare it to a 15-year mortgage. The monthly payment is higher, but the total interest paid drops by more than half. On a $400,000 loan, that's a $200,000 difference. $200,000. That is the price of choosing 30 years over 15. That is what convenience costs you. That is the bank's reward for stretching the leash. And the longer term doesn't just cost more in interest, it also slows your equity build. With a 15-year loan, you cross the 50-50 mark around year 7 instead of year 18. 11 years earlier. That's 11 years of compounding equity, 11 years of leverage, 11 years of optionality you don't have on a 30-year loan. The structure is the entire story. Now factor in refinancing. Every refinance restarts the amortization clock. Even at a lower rate, you're back at the front-loaded part where the bank takes the most. Lower rate, same trap. And refinancing comes with closing costs. 2 to 5% of the loan, so you pay thousands to start over at the part of the schedule that benefits the bank the most. The truth is simple. The 30-year mortgage is not a path to ownership. It's a subscription to your house with a trickle of ownership added on the side. That's the system. Here's why this system exists. Banks don't make money when you pay off your loan. They make money while you owe them. Every month you owe is a month they collect. The 30-year structure exists because it produces the maximum interest extraction over the maximum time window without the borrower revolting. It is calibrated to the edge of what people will accept. If they offered a 60-year mortgage outright, the math would be obscene and people would say no. If they only offered 15-year terms, monthly payments would be too high and home sales would collapse. 30 years is the sweet spot, big enough to keep payments manageable, long enough to extract a fortune in interest, short enough that people sign without flinching. It is product design, and the system is reinforced by everyone in the chain. Realtors get paid on the sale price, so they push you to the top of your budget. Lenders get paid on the loan size, builders, appraisers, title companies, mortgage insurance. Every party in the transaction earns more when you borrow more. There is no one in the room whose income depends on you borrowing less, and the cultural script reinforces the financial machine. Renting is throwing money away. Owning is responsible. A bigger house is success. These beliefs are not neutral. They are marketing. Marketing for a product that has a 30-year repayment cycle and a hidden front-loaded interest schedule. The most expensive purchase of your life sold with the softest emotional pitch in the economy. And the mortgage interest deduction, often cited as a benefit. But for most middle-class buyers under the new standard deduction, it provides almost nothing. Another piece of the script that quietly stopped being true. Property taxes rise with assessed value. Insurance rises with replacement cost. HOA fees rise with operating cost. Your monthly housing cost is not fixed even if your interest rate is. The trap deepens slowly. Maintenance averages 1 to 4% of home value per year. On a $400,000 home, that's $4,000 to $16,000 annually. Most buyers never factor it in. Add it all up. Interest, taxes, insurance, maintenance, opportunity cost on the down payment, closing costs on every move. The 30-year mortgage is not what the brochure said it was. Here is what this costs over a lifetime. A typical middle-class buyer who moves twice and refinances once will pay roughly $400,000 to $500,000 in mortgage interest alone. $400,000 to $500,000 for a single asset. That same money invested in a low-cost index fund over the same period would have grown to well over $1 million. The cost is not just dollars, it's optionality. A mortgage anchors you to a job, a city, a commute, a school district. The bigger the loan, the smaller your range of choices. It's risk concentration. Most middle-class wealth is locked inside one illiquid asset in one zip code. If that neighborhood declines, your net worth declines with it. There is no diversification, it's stress. The constant pressure of a payment that doesn't pause if you lose your job, get sick, or want to take a sabbatical. The mortgage is a leash that tightens under pressure, and it's time. Time spent working a job you don't love to keep up with a payment that mostly feeds the bank. Years of your life converted into interest on someone else's balance sheet. So what do you actually do with this? First, run the numbers before you sign anything. Pull up an amortization calculator and look at year 1, look at year 5, look at year 10. Second, if you're going to take a mortgage, take the shortest term you can comfortably afford. 15 years over 30 saves hundreds of thousands and gets you to real equity years faster. Third, make extra principal payments early. The first decade is when each extra dollar destroys the most interest. A single extra payment a year can shave 6 years off a 30-year loan. Fourth, stop chasing the biggest house you qualify for. The bank's qualification number is the maximum they can extract from you. It is not advice, it is a sales target. Fifth, separate the home from the investment, buy a place to live, invest separately in things that actually compound for you, not for the bank. Don't let the house pretend to be both. The 30-year mortgage was never built to make you wealthy. It was built to make the bank wealthy while you feel like you're winning. Now you've seen the schedule. Now you know.